Ask about going over a options video. I'm gonna go over the PowerPoint that I made, sorta, and a little bit of real examples on how you would do it. And so the first part of the PowerPoint that I had was talking about the options chain. This was one that I posted, and so we're just gonna look at the SPY options chain for day. And so over here, you'd have the change in the price. You have the bid, the ask, volume, open interest, implied volatility, delta, the strike, and then you have it. This side is for calls, this side is for puts, and up here is the expiration date. That's how it's laid out on Fidelity. And so, just going over what they all are, I believe it said this in PowerPoint as well. Yeah, the major four things with the option chain you want to focus are the bid and ask price, volume, open interest, implied volatility, and delta. And so you have the bid, which is the bid and the ask shows the price of buyers and sellers. The bid is the price at which someone is willing to buy your option. Ask is the price at which other people are selling their options. So if you need to buy an option, you want to look at the ask, and if you want to sell, look at the bid, because the ask is what people are selling for. So if you wanted to buy that volume, you would buy the ask, and if you wanted to sell it, you would sell the bid, because people are saying I'm bidding 124 on this option, and people that are selling, so therefore if you want it, they're saying I'm selling, I'm asking 323 for that option. That's why it's called the bid. It's what you're bidding on it. It's called the ask because it's what people are asking for it. And so then you have the volume, same thing as volume in stocks, just the number of volume of transactions that went through with regarding that specific option. And the open interest, which I believe it says in here too, is the number of contracts that are owned at that strike price and that maturity. And so, there's not many of those open. There was quite a lot of those open. And some people use these ahead of time, like saying that, since there's a large number of calls open at 264, is that an indication that maybe we're going up? Well, on the same side, you have a whole lot of puts. And but that's one thing that people definitely do, is that they look at the open interest for certain calls and put strike prices. But open interest is a number of people like holding those as well. Number of open contracts out there. Volume is the amount of them traded. Then you have the implied volatility, which is what it's the implied, like it's the amount of volatility that is shown with the options that you're expected to have. And so it's one of the pricing mechanisms that is used in options. Estimating the volatility of the security price. Okay, yeah, that's a lot better way of saying it. And that is one of the pricing things, because if you think about the probabilities, so let's see, can I open a blank Word document? So for implied volatility, like if you had a low implied volatility of just, let's just say a small percentage, you have a low implied low IV, so it stands for implied volatility. Well, low IV would maybe mean that the fluctuations on the thing are going to be about like $3 on a $150 stock. So that means by that expiration, if it was at 150, then it could either likely, based on the options, would be going to 153 or 147. And so, with options, why are they cheaper with a low IV? Well, because that means the security isn't going to move as far. And if you make money on calls or puts based on if it moves in your direction, then if you have a low IV, it's not going to therefore move very far in your direction. But if you had a high IV on a stock of 150 of, say, 10, well, then now that stock at 150 would be implied to go to 160 or implied to go to 140. So therefore, those options are going to go up in value. And delta, yeah, we have delta on there too. I believe delta was shown in that options chain. Was it? Yeah, so delta for the calls would be positive, for the puts would be negative. And then delta is just really showing you the impact of a change of the underlying security. So an example is if a stock option has a delta value of 0.65, this means that if the underlying security stock increases in price by $1 per share, the option own it will increase by 0.65. And of course, those values, because options are multiplied by 100s, you would then multiply that by 100 to see how much your option would change. And then we have the strike price. Strike or exercise price is the price at which for a call you can buy the underlying, or for a put you can sell the underlying if the security or option is exercised. So this is what we mean when we're talking about you want to buy 264 call options. So if you were to exercise this, 264 is the price that it would be exercised at. It's the strike price. And so that is the determinant, I'll go over later in the video about it, of whether the option is going to be in the money, out of the money. So the SPY closed at 263, so just real quick, I'll go over it. 262 would be in the money on calls, and 262 would be out of the money on puts. For puts, 265 would be in the money, and for calls, it would be out of the money, because calls are going up and it hasn't reached that price yet, so it's not in the money, it's not making money, and puts are going the opposite way. And real quickly, just to go over, I don't know if everyone knows, but so for instance, options, since the reason they move so much is they're leveraged, because if you exercise these things, they're built to be like insurance contracts, and so it moves, you can exercise them and buy or sell 100 share slots. So like a call option, what it actually is the right but not the obligation to buy 100 shares of a stock at the strike price. So if you were a big fund or something and you think, let's see, that by January 30th, which I doubt it moves this much, the SPY is going to be at 264. Well, you could buy a 262 call option, and if the trend you think is continuing going upward, then you've bought this call option, say for around $259, and then you can exercise it if you want. So then you would have 100 shares of the SPY while it's trading at 264 that you could be buying at 262. So then that would just be $26,200 that you could sell for more money, but you would be buying it in at 262. And when you exercise, you still have to pay for the shares, but you're getting it at a lower share price. You're guaranteed profit. And then puts are the opposite. So put options are the right but not the obligation to sell 100 shares at the strike price. All right. And so with puts, then, if you bought, say, 264 puts or something, or let's say you bought 266 puts. So let me tell you why this is more expensive, because you can sell them at a higher price. So the insurance is greater, so therefore the puts will be more expensive. So for instance, if you have the 266 puts and the market reverses and goes back down to 250, well, you already own these puts. You don't have to, you're buying them right now where they're cheap. If they go up to 250, you could sell the puts. They're going to be worth a lot more money because they're 266 insurance. They're the right to sell at 266 if you exercise them. So if you have 500 shares of the SPY and you bought, 5 put options at 266 that expire in a month and will go down to 250 by next week, and you think the trend's going to continue, well, then you could hold those options until expiration at the end of the month, and so at the end of the month you think we'll be at 230. Well, then you could sell these puts and exercise them, and you wouldn't really have a loss on your 500 shares of the SPY. You'd be fine because you covered yourself, you bought insurance. And so at the cost of a little bit of money, you were able to cover your catastrophic losses. And that's what these things were originally built to do. They're built to be insurance, and that's why these moves are so leveraged, because when you buy this for 274, the exposure is 266 of the SPY. So, like 266 times 100. So the exposure is really 26,600. So that's why if the underlying index moves just a little bit, these move a lot because they're very, very leveraged. All right. And I think that was skipping around a little bit in the way I had this presentation originally done. But basic pricing factors, you can see from the option chain earlier, the further you go in strike price, the further you go up in strike price, the cheaper it gets for calls, and that's because calls are betting that they're going up. So as you get further and further away from the strike price, like if you bought, 280 calls that expire tomorrow, I don't even know if they'd be out there, but if they're out there, they would be 1 cent because the probability of that happening is like nothing. And then for puts, if you bought like 264 puts, they'd be really expensive and they would be in the money because we're below 264. Say if you bought 220 puts, if they're even out there once again, then and they will be for further expirations, but for closer expirations, if they're out there, they're going to be very cheap, like at pennies. Really, 250 or 245 puts would probably be at pennies for close expiration, because you don't really expect the move of that far. And options are all priced on probabilities, and the probability on that, going with the current IV or implied volatility that we have, makes the probability of that over the next couple days very, very low. So the option, since it's a almost zero probability, is priced at almost $0. Yeah, make sure you remember that these are based around buying 100 of something. So if you buy an option at 0.54, it will cost you $54, not 54 cents. And then I was just showing, this is something in the PowerPoint, I was just showing the power of options. Is like this move on Tesla, there was no basically implied volatility. And then you had Musk get charged by that SEC thing. And so if you had put options that expired in 2 days, I think it was 280 put options for this one, then those had the implied volatility skyrocket, and they went way, way, way in the money. So this 13% drop that was nearly 14% that was completely unexpected, I believe made those specific put options change about 14,000% in your favor by open. So crazy amounts of money. You could have got rich overnight. Now, of course, no one could have predicted that. Some people just got lucky. But that's just how leveraged these things really are. Yeah, this is just talking about what happened with that play. And I think that, yeah, that's pretty much the end of the PowerPoint. But I just wanted to go over with you about options. So you need to understand the option chain. For it to be liquid, you want to see a higher amount of open interest, because that shows you how many people actually own the option, so therefore they can buy and sell it if they so wish. And if you have the amount of capital available, then you're going to want to buy usually somewhere this would be a nice range, somewhere close to the money. Now for close expiration, you can see those, or what is it, this one, that bid-ask spread is huge. You wouldn't want to buy that, but out in the further expiration, I suppose, yeah, you can see these spreads getting real close, and that's what you want to see. That means it's probably a pretty liquid option, and you can see the high open interest here means that it's pretty liquid. And so you don't want to, if you buy 280 calls and the index goes up, really high, well, they may go from 1 to 2 cents, but you may not even be able to sell them. And so you want to try to buy as close to in the money or where the thing is actually at, probably, as you can. I mean, I usually buy $2 out of the money, depending on how long I'm planning on holding them. I mean, and it all depends on if you buy with further out, you want it to be a realistic scenario where it's kind of possible and probable, but it doesn't have to be you can buy if the SPY is at 255 and you think it's going to go to 258 or 59, you can buy a 260 call and you'll be fine. But if it's at 255 and you think by the end of the day it's going to go to 258 or 59, don't buy a 290 call. This is not going to help you. So it wants to be kind of probable, very possible like scenarios that you trade, and that's what you need to think about when you buy these. Like, can it actually reach those prices by that time? Because think of like the probabilities. You know, if you have a 260 call, and when you bought the SPY was at 255, when you sold the SPY was at 259, then those options go up a lot because the probability that it's going to reach 260 now by expiration has gone up a vast amount. Anyway, that was just kind of like a basic introduction of how you can play a lot of these stuff to options. Maybe in way more advanced videos we could talk about like covered calls and stuff, but you need to just kind of understand like really that what the options are is their right to buy or right to sell, and that's why that like you can do covered calls or you can hedge your portfolio, because these things are built to be insurance kind of. And so once you understand all that, these more complex scenarios I think will make a little bit more sense. Maybe that'll tell you kind of why these things move and move as much as they do, and why you would want to buy certain strike prices. You don't have to buy the exact one that I usually buy when I talk about it, but you'll kind of know remotely where to be. Like, for instance, it didn't do it today, but you know, like right here at 263.50, if we thought we were going to go to 266, a 265 call would be good because it's going to sell up here. It's going to be in the money. So it's going to have a good bit of value that it gained from here and here. It has some intrinsic value versus just, and so that would be a good price. And 254 would be fine too. Also, probably like 267 would be fine, because by the time you get up here, they're not going to be out of the money. But like now you understand that probably 280 couldn't do it, and that's why you wouldn't want to buy that option. And also 240. If it's something far out in expiration, you may not want to buy that, because the probability, you know, if it's like a 2-day and you got 266 calls, well, from here to here, if we did fill the gap, the probability of reaching 266 now is just like a couple cents away. So that probability has increased drastically. So the price of the option should therefore increase drastically. And so just think, if you were looking at these and say if you were like a rich guy or a hedge fund and you were planning on exercising these options, did the probability that if you were going to exercise these, that they would be making money, did that probability increase? And that'll kind of tell you, like, if you're buying a good option, how much the option's going to move and stuff like that. So anyway, hope that helps some people. Hopefully that sparks questions. As always, if you have any, just DM me, let me know, whatever.